Building wealth is often misunderstood as something that requires high income, risky investments, or lucky timing. However, one of the most reliable and accessible ways to build long-term financial security is through compound interest. It is a quiet but powerful financial force that rewards patience, consistency, and time more than anything else. Compound interest works by allowing your money to generate returns, and then those returns themselves begin generating additional returns. Over long periods, this creates exponential growth that can turn small, regular investments into substantial wealth. Today, we will talk about how to use compound interest to get rich slowly. So, before we start, make sure to hit the like button and subscribe to my channel. At its core, compound interest means earning interest not only on your original investment, but also on the interest that accumulates over time. This is different from simple interest, where growth is always calculated only on the original amount. In compound interest, each cycle of growth increases the base amount, which means future gains are always slightly larger than before. At first, this difference feels small and almost unnoticeable, but over time it becomes powerful enough to completely change financial outcomes. Time is the most important ingredient in compounding. The earlier someone starts investing, the more time their money has to grow. Even if two people invest the same amount of money, the one who starts earlier will almost always end up with significantly more wealth. This is because compounding does not grow in a straight line. It grows exponentially. In the beginning, the growth appears slow, but after enough years, it begins to accelerate dramatically. That acceleration is where real wealth is created. A helpful way to understand this is to imagine a small snowball rolling down a long hill. At the very beginning, it is tiny, light, and almost easy to ignore. It moves slowly and does not seem impressive at all. But as it continues rolling, it starts collecting more and more snow along the way. With every turn, it becomes slightly bigger, and because it is bigger, it picks up even more snow than before. The process feeds itself. Eventually, what started as something small and insignificant becomes a massive snowball with unstoppable momentum. Compound interest works in exactly the same way. Your money begins as a small amount, but as time passes, it earns returns, and those returns start earning their own returns. Over years and decades, this cycle repeats again and again until growth becomes powerful, accelerating, and far greater than most people expect when they first start. One of the biggest advantages of compound interest is that you do not need a large amount of money to begin. You can start with very small contributions, and over time, those small amounts can grow into something significant if they are allowed to compound for long enough. The real power does not come from how much you start with, but from how long you stay invested and how consistently you keep adding to it. A person who invests small amounts every month without interruption can often end up with more wealth than someone who invests large amounts inconsistently or starts investing much later in life. This is because compounding rewards time and discipline more than short-term intensity. The key is not the size of the initial investment, but the consistency of contributions and the patience to let them grow over many years. Consistency is what activates the full power of compounding. Investing once or twice does not create meaningful long-term results. However, investing regularly over many years allows the compounding effect to build momentum. This is why many investors use automatic monthly contributions. When investing becomes automatic, it removes emotion and hesitation, ensuring that money keeps flowing into investments regardless of market conditions. Reinvesting earnings is another critical factor. When you earn interest, dividends, or profits, withdrawing them slows down the compounding process. But when those earnings are reinvested, they become part of the growing base. This means future returns are calculated on a larger amount, which accelerates growth even further. Over time, reinvestment is what turns steady growth into exponential growth. The type of investment you choose also matters significantly. Not all investments compound at the same rate. Low-risk savings accounts may offer safety, but their returns are often too small to generate meaningful long-term growth. Investments like diversified index funds, stocks, and long-term equity-based assets tend to offer higher returns, which significantly improves the power of compounding over decades. However, higher returns usually come with higher risk, so balancing growth and safety is essential. Staying disciplined during market fluctuations is another key factor. Markets naturally go up and down, sometimes sharply. Many people make the mistake of withdrawing their money during downturns because they fear losses. However, this interrupts the compounding process and locks in temporary losses. Long-term investors understand that downturns are part of the cycle and continue investing regardless of short-term volatility. In fact, lower prices during downturns can actually help long-term compounding by allowing more units of an investment to be purchased. The rate of return plays a huge role in how fast wealth grows. Even a small difference in percentage returns can lead to massive differences over long periods. For example, an investment growing at a slightly higher rate can end up producing significantly more wealth after 20 or 30 years due to the exponential nature of compounding. This is why selecting investments wisely and understanding risk versus reward is so important. One of the most common mistakes people make is delaying investing. Waiting too long reduces the number of years your money has to compound, and those lost years can never be recovered. Another mistake is stopping investments during difficult financial periods or market downturns, which interrupts the compounding cycle. Some people also withdraw their earnings too early, which prevents their investments from growing to their full potential. Inflation is another important factor to consider. Even if your money is growing, inflation reduces its real purchasing power over time. This means your investments must grow faster than inflation to actually increase your real wealth. Otherwise, you may see numbers increase on paper without gaining real financial strength. This is why long-term investors often focus on investments that historically outperform inflation over time. Psychology plays a major role in whether or not people succeed with compound interest. In the early stages, growth is slow, and it can feel like nothing significant is happening. Many people lose patience and give up too soon. However, those who understand the long-term nature of compounding stay invested and continue contributing even when progress feels invisible. The biggest rewards come to those who can stay patient long enough for the exponential phase of growth to begin. Automating investments can make this process much easier. When contributions are automated, investing becomes a habit rather than a decision. This removes emotional interference and ensures that investments continue consistently over time. Automation also helps maintain discipline during both good and bad financial periods. Long-term thinking is essential for benefiting from compound interest. This is not a strategy for quick gains or fast wealth. It is a strategy that rewards patience over years and decades. People who focus on long-term outcomes rather than short-term fluctuations are far more likely to experience significant financial growth. Ultimately, compound interest allows ordinary people to build extraordinary wealth slowly and steadily. It does not require perfect timing, large starting capital, or complex strategies. It simply requires consistency, patience, and time. The earlier you start and the longer you stay invested, the more powerful the results become as your money begins to work harder than you do. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.